Right now, as you're watching this, there are stocks paying 10, 12, even 16% dividend yields, and millions of Americans are pouring their hard-earned money into them thinking they've found a gold mine. They haven't. They've walked straight into a trap. In 2025 alone, 145 publicly traded U.S. companies slashed or eliminated their dividends, and investors who ignored the warning signs didn't just lose their income, they watched their entire portfolios get destroyed. Walgreens, Intel, Dow Chemical. These aren't obscure penny stocks trading on some shady exchange. These are names your parents and grandparents trusted for decades. And every single one of them flashed the same 3 warning signs before the axe fell. Today, I'm going to show you exactly what those 3 warning signs are, using real companies and real numbers from 2025, so you never fall into a dividend trap again. And stick around to the end, because the 3rd warning sign is the one that catches even experienced investors completely off guard. Let's start with the basics. What is a dividend trap? A dividend trap is a stock that lures you in with a big, juicy payout that looks irresistible on paper. But underneath the surface, the company is bleeding out financially. The dividend yield is high, not because the company is generous. It's high because the stock price has been cratering. Think about it. Dividend yield is just the annual dividend divided by the stock price. So when the price falls off a cliff, the yield shoots up artificially. And when the company finally admits it can't afford the payout anymore, it slashes the dividend, the stock tanks even further. And you're left holding the bag with less income and less capital than you started with. It's a double whammy. You lose both ways. Morningstar's Dan Lefkowitz put it perfectly. A dividend trap is a stock that lures investors in with a big, fat payout that ends up being unsustainable. And it's not just a loss of income. It's usually also accompanied by a share price decline. So how do you spot one before it's too late? Let's break down the 3 warning signs. Warning sign number 1. The payout ratio is through the roof. Here's the simplest question you can ask about any dividend stock. Can the company actually afford to pay this? That's what the payout ratio tells you. It's just the percentage of a company's earnings that goes toward paying dividends. A healthy payout ratio is typically somewhere between 30 and 60%. That leaves plenty of room for the company to reinvest in its business, pay down debt, and handle unexpected downturns without breaking a sweat. But when that ratio creeps above 80%, you're in the danger zone. And when it goes above 100%, the company is literally paying out more in dividends than it earns. That is not generosity. That is a ticking time bomb. Let me give you a real example that played out right in front of everyone's eyes. Dow Chemical. Before Dow slashed its dividend by 50% in July 2025, its payout ratio was absolutely astronomical. Dow's earnings per share hadn't covered its $2.80 annual dividend since 2022. In 2023, the company paid out more than 3 times its earnings per share as dividends. In 2024, the payout ratio was nearly 180%. Think about what that means. For every dollar Dow earned, it was paying out almost $2 in dividends. Where was the rest coming from? Debt, cash reserves, anything they could scrape together? Even the most optimistic Wall Street analyst projections showed that maintaining the old dividend rate would have resulted in a payout ratio above 100% in 2025. The math simply did not work. And here's what makes this even more painful. As recently as March 2025, Dow's CFO Jeff Tate was publicly saying, and I want you to hear this, "We remain committed to our dividend moving forward. We're in a good position to support our dividend for the next several years." Just 4 months later, they cut it in half. The stock dropped over 16% practically overnight. The adjusted loss came in at 42 cents per share, more than triple what analysts expected. Revenue fell 7% year over year. Investors who trusted the words instead of the numbers got absolutely crushed. Now here's the thing that should keep you up at night. Dow isn't the only one playing this game. B&G Foods, the company behind Green Giant vegetables and other household brands you probably have in your pantry right now, was sitting at a 95% payout ratio with a 7.7% yield heading into 2025. Sounds incredible, right? Until you realize the company was spending almost every penny it earned just to maintain that dividend. One bad quarter, and it all falls apart. And bad quarters were exactly what B&G was delivering. First quarter 2025, sales dropped 10.5% year over year. The lesson is dead simple. If a company is paying out more than it earns, that dividend is living on borrowed time, period. Warning sign number 2. Earnings are in free fall. Pay close attention to this one because this is where things get really dangerous. Even if a payout ratio looks manageable today, it means absolutely nothing if the company's earnings are collapsing. Think of it like this. A company earning $5 a share with a $2 dividend looks safe. That's a comfortable 40% payout ratio. But what happens when earnings drop to $2? Suddenly, you're at 100%. What about $1? Now the dividend is twice the earnings. The payout ratio exploded, not because the dividend changed, but because the earnings disappeared underneath it. This is exactly what happened with Walgreens Boots Alliance. For decades, Walgreens was the definition of a reliable dividend stock. It had been paying dividends for over 90 consecutive years. It had been increasing that dividend for almost 50 years straight. Your grandparents probably owned this stock in their retirement portfolio. It was supposed to be absolutely bulletproof. But the earnings told a completely different story. Walgreens posted operating losses in 3 of its last 4 quarters. Revenue was shrinking. Competition was intensifying. The stock had fallen more than 80% over 3 years, and by the time its yield climbed above 10%, that wasn't a sign of strength. It was a cry for help. The price was collapsing so fast that even the reduced dividend looked enormous as a percentage of the cratering stock price. In January 2024, Walgreens slashed its dividend by 48%. Investors thought, okay, that's painful, but at least now the dividend is sustainable. It wasn't. On January 30th, 2025, Walgreens suspended its dividend entirely, completely gone. After more than 90 years of consecutive payments, the income stream just vanished overnight. The stock tumbled another 15% in a single day. The company cited cash needs for litigation, including a massive Department of Justice lawsuit accusing it of dispensing millions of unlawful prescriptions, and debt refinancing. It had just $859 million in cash against more than $7.6 billion in long-term debt. The writing was on the wall for anyone willing to read it. And Walgreens wasn't alone in this devastating pattern. Look at Intel. Once the undisputed king of semiconductors, Intel watched its earnings get gutted by competition from AMD, the explosive shift toward AI chips, and a post-pandemic collapse in PC demand. Its data center revenue plummeted, profits were decimated, and by August 2024, the company suspended its dividend completely. The stock plunged 26% in a single day. Its worst drop since 1974. More than $30 billion in market cap evaporated practically overnight. One analyst called Intel's problems approaching existential. Here's the critical takeaway from these stories. Don't just look at what a company pays. Look at what it earns. If earnings are trending downward for multiple consecutive quarters or years, that high yield is a mirage. It's not a reward. It's a warning siren. Warning sign number 3. The debt is drowning the company. This is the one most people miss completely. This is the silent killer that sneaks up on investors while they're too busy staring at yield numbers on a screen. A company might have a manageable payout ratio. Its earnings might even look okay on the surface. But if the company is loaded with debt, everything becomes fragile. High debt means high interest payments, and those interest payments get first priority. Before dividends, before growth investments, before everything. When times get tough, the dividend is the first thing on the chopping block because the lenders always get paid first. Always. Let's go back to B&G Foods. This company carries over $2 billion in total debt. Its debt-to-equity ratio? A staggering 430%. Its interest coverage ratio is just 1.3 times, meaning it barely earns enough to cover its interest payments, let alone fund its dividend. Its Altman Z-score, a widely used metric for predicting bankruptcy risk, sits at just 1.48. Anything below 1.8 is considered the distress zone. B&G Foods isn't just flirting with danger, it's living in it full time. And the dividend yield? Over 16% to a brand new investor scrolling through a stock screener that looks like Christmas morning. To anyone who actually understands what that debt load means, it looks like a funeral. Now look at Dow Chemical through this lens too. Before its dividend cut, Dow's dividend payments exceeded its free cash flow in both 2024 and 2025. Its leverage ratios were well above management's own stated targets. When you're borrowing money to pay dividends, you're essentially using a credit card to cover your rent. It works until it doesn't. And when it stops working, it stops all at once. Even Intel's collapse was amplified by its debt spiral. By 2025, Intel had accumulated over $50 billion in debt, up from essentially nothing in 2010. While it still had around $21 billion in cash and short-term investments, the massive debt load meant every single dollar had to be carefully allocated to manufacturing investments and operations. There was simply nothing left to hand shareholders as a dividend. This is why debt is the warning sign that separates the investors who see the crash coming from the ones who get buried by it. The 3-check rule. So let me tie this all together with a quick framework you can use right now, today, before you buy any dividend stock. Think of it as the 3-check rule. Check number 1. Is the payout ratio below 60%? If it's above 80%, proceed with extreme caution. Above 100%, walk away immediately. Check number 2. Are earnings stable or growing? If earnings have declined for 2 or more consecutive years, that juicy yield is inflated by a falling stock price, not by company strength. Check number 3. Is the debt manageable? Look at the debt-to-equity ratio, the interest coverage ratio, and free cash flow. If the company can barely cover its interest payments, the dividend is expendable. If a stock fails even one of these checks, dig deeper before you invest a single dollar. If it fails 2 or 3, run and don't look back. Why this matters right now. Now here's why this matters more right now than maybe any year in recent memory. The U.S. trade war has thrown corporate earnings into absolute chaos. 145% tariffs on Chinese goods. China retaliating with 125% tariffs on American imports. That effectively sealed off a $650 billion trading corridor that entire American industries depended on. Companies that were already stretched thin, like Dow, like B&G Foods, suddenly had even less room to maneuver. Earnings projections were slashed across the board. Companies pulled their forward guidance, and the dominoes started falling. According to Standard & Poor's data, 145 U.S. companies decreased their dividends through October 2025 alone. That's not a handful of bad apples. That's a systemic warning signal. And the sectors hit hardest, energy, materials, and financials, are exactly where yield-hungry investors tend to park their money. The bottom line is this: in a market where uncertainty is the only certainty, Chasing yield without doing your homework is playing with fire. The stocks with the highest dividends are often the ones closest to cutting them. That flashy 10% yield doesn't mean much when the stock drops 40% and the dividend vanishes completely. Focus on total return, not just income. Look for companies with growing earnings, manageable debt, and sustainable payout ratios. Those are the stocks that will pay you reliably for years and decades to come, not just until the next earnings call. Now, here's my question for you, and I genuinely want to hear from you in the comments. What's the highest dividend yield you've ever been tempted by? And did it turn out to be a trap or a treasure? Drop your answer below. I read every single comment, and I'd love to hear your stories, because we all learn from each other. If this video opened your eyes to something you didn't know before, smash that like button. It helps more people find this video and avoid making expensive mistakes. Share it with someone who's chasing yield right now. Seriously, it could save them thousands of dollars. And if you're not subscribed yet, hit that subscribe button and the notification bell so you never miss a video like this. I'm putting out new content every single week to help you build real, lasting wealth, not just chase numbers that look good on a screen. I'll see you in the next one.